Welcome to the Deep Dive. We're here to cut through the noise of financial reports and really get to the core of what's happening strategically. Today, we're looking at the Walt Disney Company's recent earnings call. And it was pretty fascinating, wasn't it? There's this duality. The numbers, especially profits, looked good on paper. But the market reaction, well, that seemed to tell a slightly different story. Disney's definitely at a crossroads, undergoing some massive changes.
Exactly. And that's our mission today, really, to go beyond those immediate headlines. We want to help you understand the key strategic shifts, the financial implications that really came out of that call. Because the numbers, yeah, they tell part of it, but the story management is trying to build the underlying strategy. That's where the real long-term picture lies for you.
Okay, so let's kick off with those headline financials. Because like I said, on the surface, profitability looks strong. They reported GAAP EPS, that's generally accepted accounting principles, the standard way of reporting of $2.92.
Which was huge.
Yeah, absolutely crushed the street consensus of $1.30. That's a massive $1.62 beat.
Right. And
their adjusted EPS, the non-GAAP number, which strips out some one-off things for a clearer operational view, that also beat expectations. $1.61 versus the $1.45 consensus, about an 11% beat there.
Still very solid.
But then there's the counterpoint. Revenue. It came in just a hair under expectations.
Sure.
$23.65 billion against a $23.70 billion forecast. I mean, it's tiny, a 0.2% miss, and still 2% growth year over year. But
so that slight miss, yeah. Especially when you factor in the ongoing worries about traditional linear TV. It definitely colored the market's immediate reaction. Yeah. Despite those really strong EPS beats, the stock actually dipped initially in pre-market, maybe around 4%.
Oh, interesting.
And the trading volume was significant right away. Like the first 30 minutes saw roughly double the usual 20-day average volume. So investors were definitely reacting, trying to square that profitability beat with the slight revenue miss and the linear concerns.
So profit up, but questions about growth and the old TV model linger.
Pretty much. Though on the plus side, segment operating income was up 8% year over year, and free cash flow looked really robust. $1.89 billion, which is 53% higher than last year. So they are generating a lot of cash.
Okay, let's unpack the strategy then, because that feels like the main event here, right? Bob Iger's message seemed pretty clear. He said Disney is not done building, and they're operating from a position of strength, even as the industry kind of contracts around them. It really frames this shift away from, that old scale at any cost streaming idea.
Yeah. Just get subscribers, worry later.
Exactly. Towards something more like disciplined, synergistic monetization. What does that actually mean in practice for Disney now?
Well, it's a pretty fundamental shift, actually. It means moving beyond just chasing subscriber counts and really focusing on building a streaming business that makes money and works together seamlessly. Two big parts to this. First, the big one, fully integrating Hulu into Disney plus Bolera. One single app. They're combining all that branded Disney stuff with the general entertainment from Hulu, plus news, plus sports, calling it a one-of-a-kind entertainment destination.
Sounds convenient, at least.
It's more than just convenience for you, though. They're banking on higher engagement people, watching more, lower churn, so fewer people canceling, and really big operational efficiencies, especially moving to one single tech stack. Think about it. One platform means less duplicated work, lower costs, faster updates.
Makes sense.
Plus, they see bigger potential for ad revenue and much better bundling options. Management's actually throwing out a number. Potentially $3 billion in synergies over 3 years just from this integration.
Wow, $3 billion. That's significant.
It is. It shows how much value they think is locked up by having separate platforms. And worth noting, Hulu is set to become their main global brand for general entertainment, replacing that Star tile you see internationally.
Gotcha.
And the second part is just investing in the Disney Plus app itself, adding new features, better personalized homepages, all that stuff designed to keep you engaged, keep you watching.
Okay, now let's talk sports, because this is where things get really interesting, especially with ESPN. They announced the ESPN Direct-to-Consumer, the DTC service, launching August 21st.
Yep, that's the date.
So for the first time, fans can get the full ESPN networks without needing cable. What's this service actually going to look like, and how big is this NFL deal tied to it?
This is a massive step for ESPN. The features they're planning sound pretty ambitious. Multi-view, so you can watch multiple games at once. Enhanced personalization based on your preferences. Deep integration of stats, betting features, fantasy sports, even e-commerce. And a personalized sports center feed. It's meant to be a complete sports hub.
So much more than just streaming the channels.
Exactly. And the NFL deal underpinning this, it's huge. ESPN is basically acquiring the NFL network and some other media assets from the league. And in return, the NFL gets a 10% equity stake in ESPN itself.
Whoa, okay. So the NFL becomes a part owner of ESPN.
Precisely. It's not just a content rights deal. It's a strategic partnership. Disney kind of de-risks ESPN's future a bit, brings the NFL inside the tent, and doesn't have to lay out a ton of cash up front. It fundamentally changes the potential future for ESPN.
How does it change the programming?
Well, it gives ESPN way more NFL games, 28 windows now, up from 22. Full NFL network content integrated into that new ESPN app, expanded rights for NFL highlights, plus separately, they also locked up exclusive rights for WWE Premium Live events, really beefing up the sports offering.
And financially, does this NFL deal pay off quickly?
Management expects it to be accretive in year one, which just means they think it'll add to earnings per share almost right away, maybe about a nickel per share, even before some accounting complexities. The deal itself should close by the end of next calendar year. It really cements ESPN's position.
Okay, shifting gears from screens to, well, real-life experiences. The experience segment parks, resorts, cruises seem to have another killer quarter.
Oh, absolutely. It really carried the results again. Operating income for the segment was up 13% year over year.
And domestic parks especially.
Domestic parks were up 22%. Really strong.
It just shows the power of those physical experiences, doesn't it? What specifically drove that strength?
Yeah, the parks were just a powerhouse. You saw Walt Disney World reporting record revenue for the third quarter. Disneyland Paris also did well, partly because the comparison to last year with the Olympics nearby was easier.
Right.
And the cruise line business is booming. High occupancies, really strong forward bookings, up 6% for the next quarter.
And they have new ships coming too, right?
They do. And that's strategically important. You've got the Disney Destiny and then the Disney Adventure, which is going to be their biggest ship ever, carrying around 7,000 passengers, and it'll be based in Asia. Management sees these ships as like floating ambassadors for the brand globally, opening new markets, building that Disney connection worldwide.
Interesting. Beyond the big segments, did they talk much about just running the business better, innovation, cost control, that sort of thing?
They did. There was a clear emphasis on continued cost discipline. They pointed to cuts in content spending and also an SG&A that's selling general and administrative costs. Those cuts helped offset some of the decline in the traditional entertainment segment's operating income. It shows the restructuring efforts they've been doing are starting to bite, making things leaner, even as that linear TV business shrinks faster.
So tightening the belt is working.
It seems to be helping the bottom line, yeah. And they also teased some tech innovations coming down the pike, things like a unified ad tech platform called Mission Control, more real-time personalization for streaming viewers, and even an AI-driven system for managing park operations.
AI in the parks. Okay.
Yeah, aimed at efficiency, reducing costs, and maybe even making your park visit smoother. These aren't just buzzwords. They're tools for improving the business across the board.
So let's pull it all together. What does this mean for you if you're watching Disney closely? Management sounds optimistic, right? They raised their forecast for next year's adjusted EPS.
That's right. They bumped the fiscal 2025 adjusted EPS guidance up to $5.85 from $5.75 previously. And they gave some specific targets, too, aiming for $1.3 billion in profit from the direct-to-consumer streaming business.
Profit, finally.
Profit, yes. And double-digit operating income growth in the overall entertainment segment. They also lifted the guidance for experiences operating income slightly to plus 8%. So yeah, the C-suite message is definitely positive.
But then why the market's sort of hesitation? That initial dip?
That's the divergence we talked about. Management sounds, constructively bullish. They're pointing to streaming, getting profitable, the strategic moves they're making. But the market, it seemed more focused on that tiny revenue miss and, maybe more importantly, the fact that the decline in linear TV seems to be accelerating.
The cord-cutting problem isn't going away.
Exactly. It connects to that wider industry trend. Plus, the ad market is still kind of mixed, even while the parks are riding high on the travel rebound.
It's complex. How is the stock actually done overall leading up to this?
Well, that's worth remembering. Disney stock was actually up about 32% year over year going into the call, compared to the S&P 500's, 8% gain year to date. So it had a strong run. Maybe some profit taking was inevitable.
And you mentioned Disney is thinking about its media business differently now.
Yeah, they're trying to frame it as one whole television business, blurring the lines between linear channels and streaming. The goal, they say, is just to reach viewers, especially sports fans, wherever they are, Cable, streaming, doesn't matter.
That makes sense conceptually, but turning that into reality must be the challenge.
That's the trillion-dollar question, right? How fast and how effectively can they migrate those audiences?
Looking ahead then, what are the big things to watch for? The key catalysts?
Okay, several things on the horizon. We'll get the full reveal of that new ESPN app later this quarter in Q4. There should be subscriber additions coming from new bundled deals, like with Charter Communications. You've got the christenings of those 2 new cruise ships we mentioned, and then a big one, an Investor Day planned for December.
What happens at an Investor Day?
That's where management lays out the longer-term vision. They've said they'll outline a refreshed capital allocation plan. That could mean talk of share buybacks, maybe bringing back the dividend, things that signal confidence in future cash flow.
Okay. Any headwinds we should know about?
There's one specific accounting thing, the India joint venture. It creates about a $200 million amortization headwind annually, basically a non-cash charge that lowers reported earnings on paper. But the bigger narrative shift is key. What some saw as maybe a survival story for Disney in 2024.
Yeah, things felt a bit shaky for a while.
Right. That seems to be genuinely shifting towards a potential 2026 growth arc, built on strengthening that sports IP, being smarter about content spending, and generating record free cash flow.
So the turnaround plan is in motion.
It is. But success really hinges on 2 things: making that streaming business sustainably profitable and managing the decline of linear TV effectively. If the ESPN NFL strategy really pays off, it could absolutely re-rate the stock, meaning the market gives it a higher valuation.
But the risk?
The risk is if the park's boom starts to fade before streaming is strong enough to carry the weight. If that happens, the growth story could stall out. It's a balancing act.
Okay, let's shift gears for our final segment. And a very important disclaimer here. What follows is absolutely not financial advice. We are not recommending any specific trades or investments. This is purely for informational and, frankly, entertainment purposes, exploring an aggressive but maybe plausible market idea. Always do your own research.
Got it. Okay, so let's call this the ESPN Unleashed long-term play. Definitely aggressive. The idea revolves around using long-term call options on Disney stock. A call option gives you the right, not the obligation, to buy a stock at a set price by a future date. You'd do this if you were very bullish.
And the reason for being that bullish?
The thesis connects a few dots. The NFL taking that 10% equity stake in ESPN, the upcoming DTC launch with betting and fantasy integrated, and Disney's whole pivot to disciplined monetization. The core idea, the bet, is that this NFL deal isn't just a deal. It's the first big step towards eventually spinning off ESPN entirely, or at least creating a separate tracking stock for it.
Separating the sports powerhouse from the rest of Disney.
Exactly. The theory is that would unlock massive value. A pure-play sports media and betting company, free from the slower-growing legacy entertainment parts, could trade at a much higher multiple, a premium valuation.
What makes it outrageous versus just a theory?
The outrageous part is predicting if and when a spinoff would actually happen. That's pure speculation.
Okay.
But the plausibility comes from the recent moves. That NFL stake, the asset swap, it strongly signals that management is thinking about ESPN differently, potentially carving it out somehow to maximize its value as the sports media landscape keeps changing so rapidly.
So betting on the hidden value within ESPN being unlocked down the road.
That's the aggressive long-term play some might be considering, analyzing at least, a bet on unlocking that sports crown jewel.
All right, so let's quickly recap the key takeaways from our deep dive into Disney's quarter. We saw a really strong EPS beating expectations significantly.
Driven by cost control.
A major strategic pivot towards making streaming profitable, with that Hulu integration being central.
Yep, and the aggressive expansion in sports, ESPN DTC, the huge NFL partnership.
And all underpinned by the experiences segment, the parks and cruises, just continuing to deliver really solid results.
Definitely. And while the market had that initial sort of mixed reaction, management seems very clear on their path. They're executing this pivot towards long-term growth, long-term profitability, and there are some significant potential catalysts coming up. The question for you is really about execution risk. Can they deliver?
Which leads to maybe a final thought for you to mull over. Given Disney's pretty ambitious plans for things like AI in the parks and that real-time personalization in streaming, how could those technologies truly fundamentally reshape your experience as a consumer? And ultimately, how might that drive spending per person in the parks or keep you subscribed and engaged with their streaming services in the years ahead? Something to think about. Thank you for joining us on this deep dive. As always, remember this information is for your consideration, your understanding. It is absolutely not financial advice.